Hey everybody, Tom Gentile here. Welcome to our special webinar. We do this webinar, we do the spring summer outlook once a year. Once a year we do that, and I am coming to you guys live from my trading room. How you doing, everybody? Thought I would throw that up there real quick so you could see me. This is where I spend the majority of my time each and every weekday. My wife can definitely confirm that because she doesn't see me until late. And of course, it is late. She knows I'm in the office for an extended amount of time today because, once a year I do the spring summer outlook. Sometimes I do a spring, sometimes I do a summer. This time I thought I'd tie it all together with something called Sell in May and Go Away. We're also going to be looking at Money Calendar, Dartnet, and the option tools. And I want to show you some new things that we've done in the past year. So again, thank you all for being here on time. Before we get started, though, I want to make sure that you realize this. This is being recorded. All right, we record each and every one of our webinars for you. I'll get you a copy of this recording as soon as I possibly can. It'll be later on, a couple hours after the webinar is over. Number two, if you have questions, you can ask them in the Ask Questions box. But I'm going to warn you right now. We really have invited the entire group. Everyone who has, been with me or got something from us in the last couple of years. This is an open call, okay? An open call for all traders. And so we got a big packed house. So I'm going to apologize to you ahead of time if we don't get to your question. All right, if we don't get to your question, it's not because we don't want to. It's simply because the amount of people that are coming in this room, we're going to fill the room up. It will fill up, and there's going to be folks that aren't going to be allowed in here just simply because of the sheer size. So good that you're here on time. All right, we've got a great hour for you in our spring and summer outlook. I like to call this View from a Rules-Based Trader. All right, so the last thing I need to mention, and all of you that have been with me for some time or seen a webinar from me know that we put a disclaimer up on the screen. We put this disclaimer up here on each and every one of our webinars. You can read this from beginning to end if you like. All right, completely up to you. But you can read this from beginning to end. You can do this on the recording. This is also available at my websites, tomgentile.com, tomstradingroom.com, tomsoptiontools.com. But the parts that I want to make statements on right now are just a couple sentences. Number one, stock and option trading has large potential rewards, but also large potential risk. Number two, Jay, myself, and everyone associated with Tom's Trading Room, we are here as educators, all right? We are here under what's called the publisher's exclusion rule, which allows us to teach you what it is that we do. Now, because of that, we're not personal investment advisors. All right, we don't offer specific trading advice. You obviously need a broker to trade with. You must meet certain requirements, and everything I'm going to talk about tonight is in US dollars unless noted otherwise. So, my agenda for tonight is to talk about a pattern called Sell in May and Go Away. All right, that's called the Sell in May, Go Away seasonal pattern, which I expect the majority of you in this room to know this pattern, okay, especially if you've been with me or if you've been here before. I do have a question I want to ask real quick before I continue with the agenda. How many of you in here are in here for the very first time? All right, who's here for the first time on a live webinar with myself? Just put a yes or a Y in the question and answer box. I'm really curious to see who's new to us and who's found us through various sources, right? Because we don't do a big ton of marketing, all right? We're a very niche group here, and I like to say that we like to keep it small. And we keep, although we say we keep it small, our group has actually grown pretty good bit in size. I started off with a couple of years ago with this, writing a book called Trade Like a One Percenter. And what I did was I wanted to talk about what the top 1% of traders actually do in their trading. And it boils down to being what we like to call rules-based traders. So a rules-based trader is someone who actually takes a set of rules and applies it to their trading day in and day out, in good times and in bad, because nothing's 100%. So the rules-based trading we're going to look at today is what we call the Sell in May and Go Away seasonal pattern. All right? we're going to talk about something called the money calendar and what Darknet have to say. Now, money calendar and Darknet are two proprietary strategies that are on our tool set. You can't find these anywhere else. All right, this isn't something that's available on brokerage firms. This software is only available right here to our members. And we're going to look into these and see what they have to say for the month of May. And also, of course, we're going to be coming up with some case studies that we're going to look at as we're looking at Money Calendar, Darknet, and the option tool set that we call Tom's Option Tools. So for those of you that are new with us, it looks like we got quite a few of you here. I want to welcome you to hopefully, which is the first of many, many webinars that you attend with us. I'll let you guys know out front. Some of you have been asking, when are we going to do our Trading Essentials webinars, where we do a group of seminars a couple times a year. We call Trading Essentials, Tom's Trading Essentials, and this is a multi-week series of 3 to 4 seminars week after week. All right, I am happy to announce that in June we will be doing our I think we're going to do either a 3 or 4 week series, depending on how much do we want to get into. And that is going to be free to everybody that's on this webinar tonight. And what we'll be doing is later on in the month of May, I'll be sending you the links that you can sign up for that multi-webinar series. And that's the series we'll be going really, really deep into options, spreads. And then we're going to also do something that I like to call the wild card. And the wild card is where we take what's working best right now, and we teach that. And maybe it's a straddle, or maybe it's a calendar spread, or maybe it's a diagonal. And it's going to be, or maybe it's a different set of tools, directional or non-directional ways of spotting opportunity. So that's coming. I thought I would go ahead and announce that right now. That's a really, really cool thing that we're getting set up for summer. And I've blocked off 3 to 4 weeks during June, which we are going to put that together and make that available to everybody. So anyway, let's get started talking about selling in May and going away. Now, this is a pattern, and I'm going to tell you right now, I'm not taking credit for this pattern. This pattern, I want to give credit to my good friend Jeffrey Hirsch, who runs the Hirsch organization up in Nyack, New York. And Jeff and his father, they actually print a publication called the Stock Trader's Almanac. This publication goes out once a year, and very often in the Stock Trader's Almanac, they talk about this particular strategy called sell in May and go away. So historically, stocks perform worse between May and October, and they perform better between November and April. That's the whole pattern. And maybe you've also heard of it as buy in November and go away in May. And that's why. Because when you look at the cycles out there, there are super long-term cycles like the quadratic cycle, which is years and years in length. And then there are cycles that we pick up with the money calendar, which can be just a couple of days as a particular type of cycle, calendar cycle. But this particular cycle is roughly a 6-month cycle. May through October, November through April. Now the idea is that stocks go down between May and October. Well, we're only a couple of days away from getting into May. And it looks like, based on what the market's been doing, we took another stab up there for 2,400 on the S&P, and we fell short on it. And I'm not saying that it's not going to come, but it's interesting how more and more we're getting pops after what seems like great news. For instance, the amount of stocks, the amount of companies that beat their earnings estimates, the amount of companies that beat their earnings estimates this year was as high as it's been in years. And yet the stock market has not rallied on that. What has the stock market rallied on this year? A lot of ideas of some change that's going to happen out of Washington. However, more and more we're starting to see, like for instance, as I was reading the Wall Street Journal. So I was reading the Wall Street Journal this morning, and let me throw this up on the screen here so you can see it. Check this out. So here's your Wall Street Journal. Take a look at the top part. Trump unveils broad tax cut plan. Okay, this came out yesterday, and then when you come down to the middle page here, let's see if I can get that in focus. GOP moves closer to new health bill. So where I'm going with this is that more and more I'm finding that good news, that we're doing this buy the rumor, sell the news trick again. And so, where you would look at this in the morning, when you grab this off the driveway before you go to work, like I do, and I take a look and I go, all right, I bet the market's going to pop on this. And it really didn't. It did a lot of nothing today. And so, I look at the sell in May and go away pattern, and I look at what happened in the month of April. Is this a setup for a possible move to the downside? Volatility does rise more between May and October. And for that reason, traders typically sell their stocks in May, and they usually sit out the market in October. Not investors, but traders. Okay? So I go and I backtest strategies. I backtest this strategy like anything else. And since the 1950s, the Dow Jones Industrial Average has returned about 0.3% between May and October. That's right. It wasn't a huge sell-off. It's really a nothing. It's really a sideways market when you go back almost 65 years. It is really a nothing 6 months. Now, when you break that nothing 6 months down, it gets a little bit more interesting. But between November and April, that's where we see a lot of the returns happen on average. All right, 7.5% returns on average just in those 6 months. And so these numbers do support the sell in May and go away pattern. But it's based on the Dow Jones Industrial Average. Okay, so since then, what has happened? We have ETFs. We have the NASDAQ that's popped up. We're looking at things outside of the Dow and the S&P now. We have sector spiders, which will make their moves up and down during patterns inside of the November to April and inside of the May to October patterns. So it's important to know that. So when you look at May, now I'm going to show you when you look at May, you get an interesting view of the May through October. Most of the excitement happens in May and in between mid-September and mid-October. That's where we see the seasonality of the best chance of pullbacks happening. And of course, also in the first 2 to 3 weeks of January, we almost always see a pullback there and have in the last 10 years. So let's look at a good, better, best plan. So the good plan would be you just cash out and go to the sidelines, or go bearish and sell the averages. The better would be to go bullish on non-correlated assets. And the best would be to take a look inside of our tool set for the best setups, both bullish and bearish. So that's what we're going to be looking at here. Now, let's talk about selling the averages. Number one, sounds like a great idea. All right. But remember, the market's only pulled back 0.3% on average during the 6 month period. So this is like throwing darts at a wall. Okay. But in May alone, it could be worth the risk. So the first thing I want to do is I want to pop in and I want to look at the IVs, the implied volatilities on the Dow, the S&P, and the QQQ ETFs. I'm going to check their option prices. All right. So to do that, I'm going to pop on over here into our tool set. And I'm going to log in. And I'm going to go to an area called stock charts. All right. Now, my stock charts are going to be a little bit different. For those of you who are new, I have a little different stock chart setup than the average chart you're going to find anywhere else. So let's go ahead and type in SPY. Now, I can go through here and I can manipulate a lot of different things with my stock charts that you can do on any site. But this line right here, you're not going to find this on the majority of sites do not have this. All right. I can tell you they don't calculate it like we do. So you have a candlestick pattern here, which is the S&P 500 ETF. Now, this red line represents the 7 to 30-day at-the-money implied volatility. Now, look what happened here. The market was going down. What was the IV doing? It was actually going up, all right? And then what happened here, this is today, yesterday, Tuesday, Monday. Look at last Friday. Look where the IV was last Friday. We were at a 13 on the S&P. This is very close to similar to what the VIX is trading at. All right, because now the implied volatility on the S&P, this is based on at-the-money options that trade between 7 and 30 days to expiration. But look what happened after France had their election. Boom. I mean, in one day, we went from a 13 vol down to 8.5. That's a huge drop in implied volatility, right, as the market went higher. And since then, we had that big move up on Monday, and we've kind of followed through just little by little on Tuesday, Wednesday, and today. All right, so that's something we can take a quick peek at. Let's go ahead and just look at DIA. All right. Now, SPY, the S&P 500, is getting close to its all-time highs. All right. Let's look at DIA. DIA, I've got, in fact, I need to really go out and look at like the last 60 days. So let's just change that because it's going to give me a better representation. There's our all-time high on DIA. It's very close to 212. Well, we're at around 210 right now. So we're only about 200 points from the Dow making an all-time high. But it is not as strong. It is not as strong as S&P. But look at that implied volatility. It dropped, and it's just continued to drop as the consolidation's happening here in the Dow Jones. Finally, the strongest of the three is the NASDAQ, or the QQQ, because the QQQ's high actually was not back here in February and March. It had a high in April, and it just pushed right past it this week and made new highs upon new highs. The strength right now in the market is in technology. So if you're going to go long, in the market, tech stocks on a trend, tech stocks are where you want to be. In fact, we had a signal that came up on our tools. We had a signal that popped up actually this morning on the QQQ. It wasn't. I wish it was Friday at the close, but it wasn't. All right, it was this morning. All right, and this is a 1 week trade that we're looking at right now on the Qs. But the big thing I want to point out here is options, which were at 13.5 last week and are now trading at 10.5. That's about a 30% off in time premium. So I want you to think about this for a minute. If you have an option and the time premium in that option is, let's call it 5 points, okay? Last week, today, now it's only 3 points, all right? Not the real value of the option, but the actual time. So what this does, and what this tells me, if I were to go look at a chart type, I'm going to show you a different chart type on the Qs. This is a chart type that we look at called implied volatility. And these implied volatility charts will show you short, intermediate, and long-term IVs on options. All right. So the red line is 7 to 30 days. The blue line is 30 to 60 day options. The green is 60 to 90, and the black is the 90 plus. Those are the long-term leap options. And you can see here right now, even though short-term, the 7 to 30 and the 30 to 60 are down here low, you can see that the longer-term options are a little bit higher. And you know why? Because there's a lot more things that are going to happen between now and the end of the year. More earnings reports, more interest rate hikes, more political drama, more geopolitical drama. So, you got to keep in mind that, as of right now, it's like the short-term options are going like this. They're breathing a sigh of relief because of a couple of things. Number one, the cat's out of the bag on the tax cut plan, and that maybe we'll get a health care bill. But more importantly, we are over the hump of earnings reports and earnings season. So the only thing left to report is the ugly retail sales in most cases. And we all know where retail's going. I mean, if you're going to short anything in that May pattern going forward, retail is a great area to start looking. And I'll show you how we look into that. I'm going to make some time for that. But that's the first thing that we want to do is we want to look and see how those implied volatilities look. All right. And the reason why, if I go back to this for a moment, is take a look here. If you look at the S&P, and you say to yourself, you know what? I think the S&P, SPY, is ripe to maybe put some put options on. All right. If that's your feeling, then guess what? You, my friend, are going to be seeing some of the cheapest options that you've seen in a year. Okay. So let me bring the stock price up, and I'm actually going to overlay, let's say, the 30 to 60 day options on SPY. So what does this tell me? This tells me that it's not what's going on here. Oh, that's Citigroup, excuse me. SPY. Let's try that again. So it's not what the price of the stock is doing. It's what the price of the options are doing. They just got real cheap. They just went on sale. All right. This is like a Walmart rollback right here going on with put options and call options for that matter. Okay. So the question is, which way is it going to go? Right now, we know that options are cheap. All right, well, we'll get there. We got the sell in May and go away, and we got the idea that I'm telling you right now that May looks really interesting. I'm going to show you why here in just a second. So the second thing we could look at is, with the averages hitting near all-time highs, is there a safer place to go? And a safer place to go may be trading risk-off assets, like bonds, like gold, like the Eurodollar, as they tend to rise as the market falls. These three things are what we call risk-off assets. Risk-off assets usually do the opposite of the stock market. So an idea would be 6-month call options on these ETFs. That may be a great way to potentially take advantage of a falling market. So here's an example of that volatility chart in bonds. Take a look at where it was at the end of the year, trading up there in the high teens, where it is right now, in the mid-teens to low teens. So quite a bit of a percentage off on the TLT bond ETF. Right. So if we were to look at what those are trading at recently, you know, the at the money options, these are December. These are the end of the year December options. All right. I pulled this right off of our software. And I can see here that I'm in, you know, the area that's the lowest implied volatility. All right. My percent to double is really close to the best percent to double trade. The 123 show the best percent to double. All right. But about $453 a contract for 6, 7, 8 month options. All right. Because I couldn't find anything that was expiring in October on TLT. I had to use the Decembers. Now let's look at gold. All right. GLD. Now, I'm a big fan of gold. In fact, I've got my short-term strategy is I like to find patterns in gold that are either going up or down. My long-term strategy is I like gold as an investment. I like gold as an investment, especially, you know, look at things like Bitcoin that are just making, you know, Bitcoin's back to another, I think it went to an all-time high not too long ago. It was around 1250 last time I took a look at it, and that was last week. Okay, now it made a new all-time high. 1346.39. Let me show you that. I'm using an app called Coinbase. You guys see that right there? All right. 1346.18. Now take a look at this. There's the chart just in the last, what is that? That's the last couple of weeks. Now, way down there at the bottom, all right, and even went lower than that, is when the Winklevoss twins decided they were going to have that Bitcoin ETF, and that didn't work out for them because it was shot down, all right, by the exchanges, and Bitcoin dropped from around 1,200 down to 900 real quick. Look what it's done; it's come right back. All right, I own some Bitcoin. All right, I mined some Bitcoin several years ago, so I own some Bitcoin. I own gold. I own the numismatic gold. I'm not a collector I have coins, but I'm not a collector of specific coins. That's an area I tend to stay out of because I don't know it. I don't know that area. But I do know what a numismatic coin is worth, and so, you know, I collect those, and I use that as a physical hedge. So, looking at this ETF is showing us where the options price of GLD was. All right, right before the election, and where it is now. And do you notice it spiked up in the last couple of weeks? Well, that's because gold spiked up and GLD spiked up in the last couple of weeks. And it's come off a bit. I mean, gold's trading right above the 120 mark. You know, but if you look here, the 122s last week, this was $613 a contract. This is for the December options. Now, let me tell you something. If you've got something that's trading a 122 and it's trading for $6, you might say, well, that's kind of expensive, Tom. That's $613 for one contract. Well, it is, but when you look back, let me back up a second. Those same options are 6 months. When we were trading up here in the 20s, all right, that $6 option down here at, let's call it 14, when it's up here at 21, it was trading for 9 for 6 months. So it's come off. It's 1/3 less because the volatility has become 1/3 less. All right. A couple other, I see a lot of questions coming in. What do all these colors mean? Real quick, I've got colors that tell me what the IV, the highest and lowest IV I'm looking at in the chain that I pull back, which is not much of a chain. These are just 3 options here. But I also see the percent to double. These all qualify as the lowest percent to double in the entire chain. Volume, you know, this will highlight me where the highest volume is at that time and where the highest open interest is. And I'm going to mention this to you. I mention this in almost every webinar when we talk about options. Real quick question to the crowd. What is an option trader's best indicator of liquidity? Is it A, volume? Is it B, open interest? Or is it C, bid-ask spread? Tell me what you think, guys. A, B, or C? Wow, some of you are so fast. Linda, Leroy, I expect you to be fast. Good job. Julius, good job. Kent, Chip, Dwight, Howard, Marilyn, Pat, Victoria. I mean, you guys, almost all of you are getting it. C is the correct answer. And do you know why? Because volume and open interest, remember, these are options based on, we've got GLD is very, very liquid. And we got a lot of liquidity out there. And so, because of that, it may not translate into liquidity in volume or open interest. So keep that in mind. All right. The other thing too is that this is not the most popular option right here. The December 2017. You know what the most popular option in GLD is right now? The May 2017, the June 2017. Those the front month options. Those are the most popular. So when you see a 16 out here, don't let that bother you. When you see a 17 out here, don't let that bother you. What is the most important indicator to liquidity to an option trader? Bid-ask spread. 15 cents right here, guys. 15 cents, 10 cents on the 123s. 15 on the 121s. Important stuff. Euro dollar. So here's a chart of the euro. And the euro is really interesting because I popped this chart out last week on Friday. Let's update it real quick. Let's go look at the euro. FXE. Because I didn't look at it last time. But look at what happened right after the election. All right. And we still don't know who the president of France is yet. All right. But Wall Street seems to think they know the answer already. I remember when Wall Street thought Brexit wasn't going to happen either. I remember when Wall Street thought Donald Trump wasn't going to be our next president either. I'm not saying go out there and sell the FXE. That's not what I'm saying. I'm simply saying that sometimes these guys get it wrong. Right. And when you want to be on the other side of getting it wrong, it's much more profitable when the options you're buying have cheap implied volatility like these do here. All right. So last week, the 103s were trading for just under $4, $398 a contract. So the question that I posed to you is, which has the cheapest options? All right. We looked at TLT. We looked at FXE. We looked at GLD. And remember, GLD had the highest option prices, but according to the prices themselves, FXE was the cheapest at $398 a contract. But according to historical implied volatilities, gold had the steepest decline when we were looking at the charts on this presentation here. So, what do you look at? Well, we look at things like if you look at, say, FXE. All right, FXE, here's FXE, and I'm looking at the stock. I'm curious. What's going on? And I'm going to jump into this a little bit early. But, I look at Darknet, which is very similar to our Elliott Wave trading platform. And Darknet had a buyback on FXE back here. Last time it had a buy was in February. Had a buy in February and it had a sell not long after that. So it hasn't brought another chart up since then. How about GLD? Is there an opportunity to be spot? No. We had a buy on GLD back in mid-March, and that was right around just above 114 and a half. The sell came in above 119, almost 120. So there was a great timing in that area with Darknet. No GLD. Did we look at TLT yet? Let's take a look at TLT. TLT had a buy also in mid-March, and it had a sell. It went from 117 to almost 122. Nice move. You can definitely find some trades there that would double your money on options with that kind of a move in TLT. But there's nothing to look at there today. All right. So we'll look and see if there is any Darknet trades. But what I would do is that if I'm looking for a reason to get long any of these, all right, so I look at each of these. Let's say we look at TLT. Well, let's go look at some options on TLT like we were showing you. And I'll go out there and I'll take a look and say to myself, all right, where are my 6-month options? Well, they're going to be December. So I'm going to click on December. They really are October, but we have no October. So we're going to go out to December. We're going to click on Update. We're going to get our trades, and we're going to look at our candidates here. And what I like to do is I like to start down here where we get to maybe a buck, buck and a half. All right, so I see $1 options are out here at the 134s. So perhaps we could sell this and we could buy the 130s, and that's a really, really cheap option. We could sell the 130s and get ourselves a little closer to where we are and maybe buy the 125s. All right, if you're really looking for a way to create some cheap insurance on the stock market going down or some cheap speculation, here's $1.33, $133 debit to make a maximum profit of $367. That's a 275% return on risk right there. Here's your risk graph. Here's your risk if we go down. Here's your risk if we continue to trend, or your reward if we continue to trend up. And all we got to do is get up into this area here, this 132, 130, 131 area, and we've maxed out. All right. Even though you bought the 130 and you sold bought the 125, sold the 130, you get above 130, and this thing's maxed out. Which is a good and a bad thing. Limited reward, but a lower break even. Right. So that's another way to look at it too. Okay. So number 3 is what I call the best. And the best is actually going in and knowing that selling may and go away. Really, that back test pertains to the Dow Jones Industrial Average only. And so, we have to look at some other variables. We have to look at the fact that the market's at near all-time highs. And it could chop back. All right, it's definitely showing signs that it wants to make another pullback. But what we can do is we can look at our proprietary software and take a look and see what we're seeing coming up tomorrow, next week, and even next month with Money Calendar. So I'm going to show you kind of how we do that. And we'll look at darknet as well. And then we'll do something which I like to call direction neutral. Direction neutral, or, if you've ever heard of those hedge funds called long short funds. A long short fund is a fund that takes 50% of their money and they buy things, and they take the other 50% of their money and they sell. So they might go long Microsoft and short Intel. And that's an example of a balanced trade in the same sector. Long Amazon and short Lululemon, because you're trying to get into the retail space, but you want to buy the strong and sell the weak. All right, so we're going to look at that too, but a little bit different ways while we're looking at the Money Calendar software. So I'm going to show you guys the Money Calendar software, and I'm going to show you exactly how the steps I take when I go from our spot the opportunity to create the low risk trade to planning the trade. And so we can do that, and this is one way that I do it. One of the easiest ways to do it is with the software we have called Money Calendar. Now, those of you that are new, let me give you a couple of minutes and explain what the Money Calendar is. All right. So this is a software program that myself and my fantastic, incredible programmers helped me put together. All right. What it does is it basically hunts down patterns using a minimum of 10 years worth of historical data. And I can do this each and every day. All right. I have every day at my disposal. And so what we're doing is we're looking at millions and millions of data bits every single day. This is what I think the software is so valuable that I am in the process of being granted a utility patent for it. And then from there, what we do is we'll use other strategies like the double finder in our tools piece to try to find those reward to risk ratios of 1-to-1, 3-to-1, 5-to-1, etc. So that's kind of an idea what Money Calendar is. Now, what Money Calendar does is it does follow all my rules because we can spot opportunities. All right, that's the number one rule that I use as a rules-based trader. Spot opportunities. I like high probability opportunities. Now, when you're using probability, keep in mind that there is historical probability and then there is future probability. Future probability doesn't exist, all right? It's a coin flip. And no one can predict the future, all right? I'm going to make that perfectly clear. Not me. Not my dearly departed friend George Fontenilles, who I think about every single day. One thing that we did was we created rules-based trading strategies and systems so that we could spot things that happen over and over again. And I wish George were around to see this Money Calendar because he never got a chance to see it. I was working on it, and I was looking to unveil that thing to him, but I was nowhere near done. And it's too bad he didn't get a chance to see it because I think he would have absolutely loved it. But we look at this, so we spot these opportunities. Then we find those low-risk trading opportunities. I like to look for trading opportunities that are $500 or less, all right? Because I think you can always find a great trading opportunity for $500 or less per contract, okay? And if it's more than that, then you're doing something wrong. And then you don't know enough to how to get that trade right in the sweet spot for that kind of money. And we look at what's called price and time patterns within the 30 trading days or less. So this is an example of when I go into money counter. So I'm going to show this to you. I'm going to show you the steps, and then I'm actually going to open it up and we're going to go through it live right now. But I want to show those of you that are new to the money counter steps that we use. So I'm going back earlier in the year. And I noticed that, look at the first 2 weeks of January. Remember I said the first 2 to 3 weeks, sometimes we get pullbacks, and exactly what we did. And we started going green, really started going green January 20th. So here's Monday, January 23rd, and we're looking through Money Calendar, and lo and behold, when I click on that actual date, and let me back up here a second, what each of these color codes mean is that, for instance, I had 85 trades out of 20,000 stocks. Out of 3,000 optionable stocks, I had 85 that had 10-year patterns that had 90% or greater probability of profit based on what's happened in the past. 76 of those 85 were bullish, 9 were bearish. So if I click on that little guy, then it opens up this other window for me. And IBM, as you can see, was at the top for January 23rd. And so I look at IBM and I see it's a 26-day trade. That it has an average profit during this 26 days of $6.03. Okay. We also have something new that we added for those of you that are with us, and I want to point out some of the new features that you haven't seen before. We told our partners about this and our tools members about this earlier, just a few months ago. But we added something on called the power meter or the slope. All right, the slope it gives us an idea of whether this pattern is getting better and better and better on average year after year, or worse. If that's a positive number, all right, that's a good thing. If it's a negative number, like when I look down here and I see TOL, all right, Toll Brothers, minus 30, that tells me that the pattern's there, but it's slipping away, all right? And so I see Biogen, 125, the pattern's there, and it's coming into play. So I like to look for those positive power meter gauges. And so that's important to know too. So that's how we actually spot each day's opportunity. And then from there, let's say I like IBM. I'm going to click on IBM and I'm going to get some more information. And I see that IBM, 90% accuracy over the last 10 years. It's a 26-day trade. It's bullish because the bar is green. The green bar means it's a bullish trade. And it shows me from the beginning day all the way to the ending day. That's January 23rd to February 27th. And then from there, I'll go in and I'll look at the price details. And the price details show me that in 2007, the pattern did not work. But in 2008, all the way through 2016, it did work. Not much in 2010. But I like what's happened in the most recent years. That this thing is trading in that 7, that 5, 7.5, 10 area. But when you add all this together, it's over $6 on average the last 10 years. That's spotting the opportunity. Next thing we do is we create that low risk trade. Now we can go in here, we can select in our tools a number of different things. When you're dealing with Money Calendar, you're just going to look at calls, simple calls and puts, or what we could look at is we could look at spreads. And we can look at anything from debit spreads to credit spreads. But calls and puts would be a good place to start. And so when I click on that, then I'll show you what we're looking at. So the 170 calls on the day the Money Calendar identified IBM as a trading opportunity, the 170 calls were trading for $3.85. All right, that's $385 for a contract. Well, that qualifies as a less than $500 trade. Right, so that's creating that low risk trade, and then it's just a matter of, I like limit orders. That's another thing. I don't like chasing the market. Even if I want to buy at the market, I usually put the limit at the market so I don't get some sort of surprise that it got filled worse. Okay, so how did IBM do? During the pattern, IBM stock itself increased nearly 4.9%. How did the actual option trade do? Well, the option trade gained nearly 190%. All right, 38 times more. That's what options are made for, right? So this is right out of Tom's Tools. I'm going to show you another one, then we're going to look at May. So this is February. Look at all the green on the screen in February. And so, money calendar, I'll tell you this. On average, what we've noticed is that for 9 or 10 months out of 12, this thing not only gives us, the areas where we see more bulls than bears, but you can almost take the market averages. So you could go back and look in February. You could look at the middle of January. You could see all the way up into April, where the market moved higher, and we keep seeing green, green, green. There's a little bit of mess on the screen here between the 15th and the 22nd, and it just kept going green. So 86 trades on the 6th, 80 of them, or 93% of them, are bullish and only 7% bearish. Well, I'm going to be looking at more likely a bullish trade as the market was moving higher. It made sense. Hey, there's a friend. There's Apple. And I hadn't seen Apple on the screen for a while because Apple had been, had some, did not have a 90% pattern. But it did on this particular day, February 6th. Had a pattern that brought about $4.50 on average. Let's take a look at it. So it was between February 6th and March 17th, 90% accuracy, $4.53 on average, a 30-day trade, bullish movement. Notice here, so here's the last 10 years. Really not much of anything in 2006. Had some nice gains, really big one there in 2011. 2012, what happened in 2012? Well, I'll tell you what happened. We had a change in the iPhone, and it wasn't much of a change, and there was a lot of negativity that year, so the pattern didn't work. But it came right back the next 3 years. 13, 14, and 15. Now we're in 2016 right now, so 16, so we're looking at 2017, and so we're looking at the 125 calls for March. Those 125 calls were only $1.26. Why? Because the earnings were behind us, all right? And so we're looking at that. We didn't have an earnings period between the time the trade was put on and the ending date in March, so the volatility on this trade was actually quite low. Right? And then you can see here, how well did the trade end up doing? Well, stock increased 3.63% and 100% gain on the actual options themselves. Because all we need is a little move in the stock to get a big move in the option. But we do need a move. We all know that. We do need a move. It has to happen. All right, so you know what? Let's look at the month of May. So that means it's time for me to switch gears. Come on over. And I've already got May ready to roll. Here's May. So two things. So we'll look at May 1st. May 1st is, in fact, the month of May, as you can see here, for the most part, there's a couple of big reds on the screen. The 4th, the 12th, the 31st. Okay, but over here, let's go ahead and just look at Monday. So I see Monday, and I see a couple of bulls, and then I see a lot of my bearish trades. Now, what I like to do is I like to sort this, and I like to sort it by average profit, because I want the ones that have the highest average profit, all right? Now, I look, and then the second thing I like to do is I have to see that positive power meter, or slope, as we call it, all right? So Aetna is an interesting one because it has a lot of nice profit there, and it also has a positive slope. So if I click on AET, kind of get an idea what AET is doing. May 1st to June 8th, all right, bullish trade, or bearish trade? Let's go back and view that day again. All right, and then again, we're going to go and hit average profit. AET is an actual bullish trade. So is it possible that a healthcare stock could go up when the rest of the market's going down? Absolutely. When we talk about hedging a bull with a bear, this is a good idea. So you look at stocks that do not move like everyone else. Take a look at that. So this has an average move of just under $4. Look at the last couple of years: 722, 879, or 979, 947. What did last year do? If I click on it, I get last year's move, and I can see that for the first 10 days we kind of moved sideways and down, but then we came right out of it and moved higher and went from around 112 to getting up to around 122 before pulling back. That's a nice move right there for that particular trade. All right. So then it's just a matter of going and looking at, again, I need a trade that ends at least on the first week of June. So what do? Let's go to our stock and option table. Let's go type in AET. Okay. All of this right here within the same tool set. Okay, AET, and then I'm going to come down here. I'm going to look for June 8th. Here's June 9th. You know what I like better than June 9th? June 16th. You know why? That's the third Friday in June. The third Friday is always the most liquid option. So if in any case, in almost every case, I'll look at that third Friday. There's June. Now this is I'm only looking at stocks that are in they're 10% above or below. And that's fine, but we can change that. We can widen this graph out if we want to. But I wanted to leave it just like this for a moment. So I'm going to cut in here and make this a little bit bigger so everybody can see it. All right. So I'm looking at a stock, which is trading at $133.98. And what am I doing? I'm looking for a move. All right. A move that is how much? Come on down. Let's take a look. $3.92. We'll round it up and call it 4. So, but, you know, we're getting much more than that. Let's go ahead and move that. Let's take a look and we'll round this up as well. So I'm going to look at the option table and I'm going to say, all right, we're 133. We could go to 140. So 140 may be where I want to sell. So I could buy at 135. But if I buy and sell, I'm going to create the bull call spread, which is going to give me a lower cost trade. Buy the 35s, sell the 40s. Let's hit the risk graph. Let's see what that looks like. And I'm going to bring this down a little bit now so we can see the whole trade. $166. All right. That's the cost of a meal for two at the Capitol Grill. I know. And so buying the 135 calls, selling the 140 calls, you know, what we're buying, what we're selling, that helps offset the cost some. And all we know is now we just got to get to 140, which is right in just outside of the first standard deviation. Not that much higher than where it's gone just in the last week. We get the same move. I'm looking for this trade to happen in a month. Okay, but it can happen in the next week. Now, earnings are in the next 5 days. All right, so we have to factor that in too, that earnings could play a role. But if we look at earnings, and we could do that too, you know, we could jump over and I'll show you something else in these tools. All right, so we got something over here called stock analysis, and I can go look at what's called earnings effects. All right, so I'm gonna pop in AET and see, is there any kind of a pattern that happens before the best change before 4 earnings? Let's see if there's any pattern there. Okay, typically makes a 1.83% move before the earnings. It's a toss-up whether it's going to go up or down. So that's no big deal. All right, that's nothing. But the more important thing is, what has it done in the last 4 quarters after the earnings come out? You know, is that something we need to be aware of? 3 out of the last 4 quarters has jumped in an average of 2.8%. All right, so back to the trade that we're looking at. So $133, call it $134. All right, a 1% move is $1.30. A 2% move is $2.60. A 3% move is close to $5. Isn't that what we're looking for? Basically, about a $5 move puts it at $139. That puts us in the profit zone. All right, so those are all the kind of factors that we look at from spotting the opportunity to creating a low risk trade. All right. By the way, guys, I did not preset that up for you tonight. I'm doing it. I'm looking at it exactly like you are. Okay. And anybody that's in this room that's one of our professional traders or one of our partners can confirm that, because I do this every single week. I do it live with them. So we're bringing this stuff up and looking at it live every Monday, actually. Okay. So that was AET. You know, let's just take a look at one more. And so if we go back to the day. And again, what are we doing? Let me bring this in so that everybody can see it. All right, so I'm going to re-rank again. And you can rank this by net profit. You can rank it by accuracy. You want to see the ones that have occurred 100% of the time? Well, there's 3 of them. CMCSA, that's Comcast. HOG, which is the next one I want to look at. And BAC. Now, the reason I want to look at HOG is because I already saw that one. That one we saw on the average profit, because it was just below AET. So here's Harley Davidson. All right, vroom, vroom, everybody, because 10 of the last 10 years, this pattern has worked. This is a selling pattern, 40-day selling pattern, and that is it's actually a 30-day trading pattern, again, but 40 days when you count weekends and holidays. So average move was really only $2.76. So keep that in mind. All right, so we got to look at that when we're taking a look at the options on HOG. So we'll come on over, we'll look at HOG. By the way, what options am I looking at using on HOG? Well, we got to go back and look at that one more time. We got to look at Money Calendar. And Money Calendar said what? June 9th. So we're going to be looking at those June options in here as well. And here's the 2nd, the 19th, or the 9th and the 16th. June 16th, third Friday in June. Update. Okay, so now we're going to look at the options 10% above and below the stock price. Okay, you know what I like here? I like what Double Finder's telling us, that we're looking for. The best one to take is just to simply buy the 57.5 call options using the June options for this particular date. So if I just look at those, all right, again, I want to do the risk graph. I want to know, is this move sufficient? All right, remember, I need a $2. It says on average $2.76. The problem is that this trade is right at the money, and over $2 of it is time value. So even if it goes down by $2.76, I'm not going to make a whole lot on it. So what can I do if I want this trade? I either have to do one of two things. I got to go into money and get rid of the time value. And to do that means that we really got to get down to like the 55 calls. All right, 55 calls. Thank you, Jay. I'm so excited about these options. I looked at the wrong ones. All right, let's try this. Let's try this trade again. So $1.89. Still, we're talking about almost $2 here. So thanks, Jay. Appreciate you jumping in there for me, because I'm not looking at comments right now as I'm controlling the risk graph. And now you really know that I did not preset this up. All right, there's your put option. Stock drops, and we go into the profit zone. There's some really good, interesting support levels on this that are right around the 55 area, 54. But if we get to 55, here's the problem with this one. All right, getting down around that 55.5 area, we really are lucky if we break even. So either you got to go into money, which is go look at a higher put option, or you spread it. And that's how you get the trade to become an acceptable trade to you. Because this is, when you first look at it and go, oh, $1.89, this is cheap. This is cheap, but all you're doing is you're going to flip coins here, even if you're right. You want to find a trade that's both cheap and a quality trade that fits the profile of what it is that you're trading. All right, important to know. All right, so that was the month of May. Let's see if we got any questions, Jay, on the money calendar. Any questions on the money calendar that you see? And Howard, thanks for telling me that it was Hog, that Hog was bearish. And Michael and a lot of other guys in here that are partners and use our tools, and then understand that for bearish we need to buy puts. Thank you, everyone. See anything, Jay?
No, you're seeing what I was seeing. It was just the iteration of the puts.
Yeah, we got smart people in this room. Obviously smarter than me at almost 9 o'clock at night, East Coast time. All right, so let's see if there's any darknet contrarian strategy. So darknet, darknet is going to be slim pickings, and the reason why is because darknet is a swing trading strategy. All right, it's designed to pick off pullbacks. Well, pullbacks were happening a couple of days ago, as the markets kind of move back up today. So in order to get there, I can just go to my darknet signals. And this is a module within Tom's tool set. Now, you know what I think is really kind of neat is I'm looking at the trades that are coming up on darknet. There's 5 of them today. Now, Panera Bread Company, we know that's a stock. I get 3 different types of signals with the darknet trade. I get what's called a B for a buy. That's the first round buy. I then get an R, which is a rebuy. And then I can also possibly get an A, which is an add-on or the third buy. So these can come in stages. All right. So, when I look at Panera Bread and I see Panera Bread, and I see a buy that came out at the beginning of the year, and it sold about 10 days afterwards. And that was a nice little, about a 10-point move there. But look what's happened up here since. Is there something going on with Panera Bread Company that I might not know about when it gaps up and then goes sideways? And I know about it. There's a takeover that's happening with Panera. So this, until this company merges, gets cashed out, whatever it may be, I have to look at that and say that signal is probably not a good. No signal is going to be a good signal. All right, and so that one we have to move aside. There's going to be stocks like that you find all the time. But I find it very interesting, Jay, and anybody else who's paying attention, that the Canadian dollar is a buy. And more important, the short Russell is a buy, the ultra short Russell is a buy, and the small cap bear is a buy. That tells me that the number 3, 4, and 5 are all buys based on the fact that these they expect to go up in a down market, which means that the markets would want to move lower. So when you start to put all this together, all of a sudden this sell in May makes a little more sense, not just from what the money calendar is saying, but now from what the swing trades are saying. The swing traders, and let's take a look at each of these. So Russell 2000. There's your pro short, all right? We had a buy, rebuy, and an add-on and a sell that came back. It ended up being basically a break even on that trade. But look at this. We came down. We just had a buy signal that occurred today, right? This isn't a week ago, a month ago, a year ago. This is today, right? By the way, darknet contrarian signals are typically 20 to 30 days in length. So that's the trading strategy. It is a 20 to 30 day trading strategy. So we would be looking at options with 30 days to expiration on these particular moves. All right. And in fact, if you look over here, we already have the spot the opportunity. And then we also have looking at the low risk trade on this side too. So we've actually thrown it all together. And by the way, I apologize. I want to take us back. I'll do that in a moment. I want to show you guys that have money calendar. I want to show you something new that we're adding in later this year. The Pro Shares Ultra Short Russell is going to be very similar. All right. Had the buy and the rebuy and the sell, and then we had the buy signal here for the ultra short. Ultra short just means that it moves twice as fast. Right? It's going to move at a more accelerated speed. All right. So, for instance, if the Russell goes down for every dollar it goes, for every 1 percentage point drop it goes down, and ultra is going to go up by 2% or more, depending on how ultra it is. All right. The TZA, that's the small cap bear. That was also a buy. All right. Had a buy here and a sell. Small loser has a buy signal here. So all three of those had buy signals today, suggesting that in the next 20 days are very favorable for a swing trade in the shorts to move higher, which means the longs would have to move lower. So that is darknet. Let me take you back to money calendar for a moment. So to get back to money calendar, I am going to go up to the top. And let's go to searchers, and let's go to Tom's searchers, and there's money calendar right there at the top. So I showed you money calendar. This year we added in something called money holidays, the ability to look before and after holiday periods for trades that are favorable. Okay, money clock. For those of you in here who are looking at the markets every single day, I got a clock here that'll actually show you. It actually moves like a clock. We made it look kind of like a Rolex, like an old timepiece instead of a new one. And so you can see here, we can go from 60-minute to 5-minute bars. We can display up to 50 trades, or less, obviously, as you can see here. And you can scroll these up and down. And we can also do a look back, how many years we want to look back, or in this case, how many days we want to look back. And then we can look at the accuracy. Maybe I only want to look at trades, during the day that are 80% accurate. And, that was 100%. Let's back that up a little bit. So, let's take a look real quick at Apple. Are there any trades in Apple right now that are showing 100% buy or sell during the day? Well, what this tells me is, and you might say, well, I'm not a day trader, Tom. It doesn't matter. If you're looking to buy Apple, you don't want to be buying it around the 2 to 3 o'clock time zone, because in the last 7 days it's moved down during that time frame, and I see the clusters of bearishness that happens. After 3 o'clock's a good time to look at picking up Apple if you have a longer term trade and you're trying to figure out what's the best time of the day to buy Apple. That's what the clock does for us. It also helps day traders a lot too, because it finds patterns within the day. But that's not what I wanted to show you guys. I wanted to show you the money calendar, and I wanted to show you something that is new that's coming, something called Money Calendar Trader. This is in alpha right now. We don't have it in beta yet, but I'm going to show you how this works real quick. So check this out. So I'm going to click Money Calendar, the Money Calendar Trader, and I'm going to come over here, and I'm going to say, let me see the money calendar for... let's look at May 1st, Right now, still in its mode. So we're going into the future on both the stock and on the options. I'll let you know right now, it works better on stuff that's happening today and tomorrow because it doesn't know what the option is going to be trading at on May 1st. But what it's looking at right now is on the bearish side, the euro dollar itself looks like a bearish below target entry date of 5-1. Maximum return or return on investment, it's looking at as 85% return on investment. Right. So what did we just do? We just took the opportunity and we merged it with finding the trade. And it's telling us, hey, check out the June week 1 trade there, because that's what we're seeing right now for Money Calendar. So all we're trying to do is make it more efficient, and help you hunt things very quicker. All right. So those of you guys that are using our tools right now and you have Money Calendar, wait till you see this. It's going to be coming out later this year. All right, we're still in alpha. It's going to go to a beta real soon, and then we will have it available as soon as we possibly can to all of our Money Calendar Money Calendar software traders. Okay, so that was the Money Calendar, and we've looked at darknet contrarian strategies, and so. Guys, we looked at a number of different things using our tools. We went into the option trader portion and we were looking at options on GLD and FXE, and we were looking at options, on TLT as well. Looking at different buy to sell patterns off of some of our stuff with the Money Calendar. Looked at contrarian analysis, and we found some interesting contrarian analysis that was popping up and showing us that the sell in May isn't just a cycle. It looks like a swing that we may be swinging to the sell in May based on what was popping up today. And of course, we were using the money clock, which is also something in our professional traders package that's utilized to find the best time of the day to find something as well. All right. So at this point, what I want to tell you is that for those of you that